Ralph. So, there's been a lot of drama in the mortgage market over the past few years, I'm sure everyone has noticed. So we've had mortgage rates that were as low as 3% a couple of years ago, or even under 3%. Now they've more than doubled. We've been floating 7% lately. So to talk about what's going on and what's going to happen next, we've got three panelists. So to my left is Joel Kahn, who's Deputy Chief Economist at the Mortgage Bankers Association. Next to him is Shashank Shekhar, who is the CEO of InstaMortgage, a mortgage company based in San Jose, California. And then at the end is Afifa Saburi from Veterans United, which is the largest VA lender in the U.S. According to Home Mortgage Disclosure Act data, if I analyze the data properly. So, Joel, let me start off with you, and I guess I'll have the same question for everybody. Why have we been seeing all this volatility and drama in the mortgage market over the past few years?
Oh, where do I start? So again, thanks for having me. Always appreciate being here. The connections and conversations here are always really educational, both for me listening, but also engaging. So again, really good to be here. So starting with sort of where we were, I guess, getting to where we are now. I mean, we were at, we got two pretty good years, 2020 and 2021 of low rates, so to speak. I mean, I think we all remember 3% mortgage rates, 30-year fixed rates below 3% even in some cases. We got to 2022, I think we started the year in the low threes maybe, and rates more than doubled, hitting about 7.5% by the fall, depending on the rate that you're looking at. I think a lot of what was driving that was just sort of the tighter environment that we found ourselves in, both from what the Fed was doing, and we talked a lot about that earlier, but then also related to that, the spread between the 30-year mortgage and the 10-year treasury. So without getting into the nuts and bolts too much, mortgage rates track bond yield pretty closely, not completely locked in step, but pretty closely. And for the most part, the 30-year mortgage is about 180 or 1.8 percentage points above what the 10-year is. So historically, it's what we call it a 180 basis point spread. Right now, that's about 300 basis points or 3 full percentage points. So that spread has widened. And a lot of that was driven by the Fed starting out in 2020 as being, and through really till still now, as the largest buyer of mortgage-backed securities in the market, which does impact that spread. They had to step in 2020 to keep markets functioning, to help lower rates. But we got to a point where now they're trying to normalize, right? They're trying to get things back to the kind of world that we had before COVID. And in doing that, I think there's been an imbalance in the MBS markets, which have caused uncertainty and has made that spread wider. So in other words, investors looking at MBS have to be compensated more to pick these securities up. And so that's caused that widening. One more note here is obviously we all know what happened in March in the banking sector. A lot of those failed institutions do have large holdings of mortgage-backed securities that they're trying to get sold to other investors, and that too has been adding to the MBS supply, which is also pushing on the spread. And then finally, you have just regular volatility, right? We've all been through sort of the last few years where you can see the 10-year swing, 20, 30 basis points in the span of a day, and that too is adding to the spread. So I know I kind of threw a lot at you to start, but I don't know if these two want to chime in on that.
Yeah, sure. Joel, I think you covered practically everything from the market dynamics perspective on what's impacting the rate and why it's so volatile. But I wanted to address the production numbers a little bit, because we all talked about how roof was falling last year, and it did. And we saw with multiple mergers and acquisitions, companies shutting down, some really big ones actually. But what we failed to look at is the fact that if you look at 2022 in isolation, like if it wasn't following the year like 2021, it wasn't such a bad year. We actually did more business last year than we did in 2018, we did in 2019, we did close to about $2 trillion last year, which is a healthy market for the industry, so to say. But it's just because we were coming off of two back-to-back years of $4 trillion each, we have, of course, never seen in the industry, it felt like a 50% drop is extremely steep and significant. That's why we saw the kind of turmoil in the industry that we did last year. And if anything, this year will probably be 20-25% lower. Right? That's what the is forecasting. That's what I can see being in the trenches, being in the industry. It seems we'll end up here 6.7 kind of a market, maybe even lower where we are. So other than the problem with the interest rates and inflation being extremely stubborn and everything else that Joel mentioned, which is not lowering the rates. I mean, we probably see a week or two where we get our hopes up and then something or the other happened. The jobless claims today came at 261,000. Again, our hopes went up. We'll see how long does that last. If we see a bond rally of that or something. But really, I think what is of an even bigger concern for the industry is the inventory. Is the fact that buyers, even in a lot of markets, kind of have accepted that this is the new normal, that we will get a 6.25% kind of interest rate or 7% kind of interest rate. I do not see a lot of, even with the affordability concerns that we have, there is still enough buyers in the market. The bigger problem is that there are not enough homes for sale, and that's really impacting the production numbers even more than the interest rates itself, in my opinion. So just wanted to put the other perspective around. Joel mentioned about the interest rate. I wanted to mention where was the production numbers, where I think it's going. More importantly, what's impacting more than the interest rates, it's just the number of homes for sale.
So I think, covered around the lack of liquidity and the MBS market and the spread, but I'll talk a little bit about how this has impacted veteran buyers specifically when interest rates were very low. It was a very, very competitive market. So a lot of veterans who are showing up with no down payment option are suddenly being shut out of the market because there are all cash buyers, there are a lot of investors, 3D buyers. So not as many veterans were able to take advantage of that market. And now when interest rates have more than doubled, we do see a lot more room in the market for them. But the problem now is that interest rates more than doubled, home prices have appreciated in double-digit rates in the last 2 years. So now the issue is affordability, not the price up. They no longer can afford the same house they were looking at 2 years ago. So different challenges, but despite the challenges we have seen in the recent data, that if you look at the market share across different loan products, the conventional market as of April has actually declined by 5% year over year. If you look at the FHA market, that has risen by 51% year over year, and then the VA market was by 24%. So despite the challenges, we do see that government lending is making more room for especially these first-time buyers. That's not to say that they're not having a harder time, they are, but a lot of those buyers who are very competitive are suddenly gone from the market for obvious reasons. So those have been just some of the things that we've been noticing in the government lending sector.
And so, Afifa, you mentioned the challenges that VA buyers were experiencing when the market was really hot. And so there is a stigma, earned or not out or not around VA loans and FHA loans. A lot of listing agents tell sellers to avoid offers to come with VA or FHA loans. What are you seeing on that front? Has there been any improvements? Is it a logical decision on the part of the listing agent to say, no, don't take a VA buyer?
Yeah, so I think a lot of those statements just come from not having enough information about the product in the first place. But if we look at the growth of the VA product, I think we can say that the stigmas have been going away. If you look at the loan product in the year 2000, it only made up about 3% of the market. But now it's at 14% according to the VA, and all of this has been happening throughout the same period that the veteran population has shrunk by 10 million people. So people who are eligible for this product, that number has increased, but the growth has been rapid and steady. And then, more recent data, like if you look at issuance on GMA side, for the first quarter, I think even as of April, 45% of those buyers were first-time buyers, the issuance on there. So we do see that, the growth is there, people are more aware of the product, and a lot of it has actually been on the work that a lot of the people in this room have done, generally about VA loans. So I think the more information we get out there about the loan, the more people recognize that they are eligible for this product,
And the VA funding fee came down recently.
Yeah, in April we went down to pre-pandemic levels. So the first time we used the VA funding fee declined from 2.3% to 2.15%, which equates to over $200 million in savings annually collectively for veterans, and especially at a time like now, any sort of savings that a veteran can take advantage of. This is a great time for it. It is supposed to decline back to 1.5% in 2031, and that in itself could save veterans at least $600 million annually.
Okay, so speaking of savings or lack thereof, so we've heard speaker after speaker over the past few days talk about the rate lock-in effect. And all these millions of homeowners who've got 3% mortgage rates, so they're not going anywhere. And rates now are flirting with 7%. How far down do they have to come to sort of unwind that lock-in effect, and when is that going to happen?
Here, I can start. Sure. So I think there are many different pieces that are moving. I think, again, we've covered it, but I'm going to give you my take. One is absolutely agree that you are going to have a large segment of homeowners who are looking at a 3% 30-year fix, or like I said, in some cases less than that, or even a 15-year where they're going to pay it off quicker with less sort of lifetime interest. But we have seen data from other analysts that have showed people willing to move where, how do I put this, where there's a greater benefit, I guess, where there's a bigger upgrade in terms of the home. So they might be giving up a 3% rate on a house that, let's just say, is 20, 30 years old, but they might be looking at a new construction, either further away or in a maybe a more desirable neighborhood, and willing to give up that because they're getting something sort of newer and better in a way, and again, willing to maybe absorb that higher rate. And so what I'm getting at is, we've seen data from Freddie Mac showing the in-county moves. I think the share of in-county moves has been declining. You have seen people moving out of the county, out of state, for various reasons, whether it's job-related, whether it's quality of home-related. Obviously, affordability is a big one. But then also, when you kind of slice that and dice that by the metro areas, I think you're also seeing still some moves towards more affordable areas. So, there's the rate discussion, but there's also, how do I make up for the fact that I'm giving up a lower rate? I'm going to get a better house, maybe, or even sort of same mortgage payment, right? Just a different lifestyle, if you will. So, generally speaking, I think there certainly has been activity even without rates having to go low. So I'm going to stop there and let these guys go.
Sure, I don't think we will know for sure what interest rate there could be that critical mass. Like, okay, we can get to 5.25, that's when I'm willing to give up my 3%, and I'm willing to go to 5.25. But what I've noticed is that there is a sense of initial shock. So when buyers saw the rates move from 3% to 6.5%, 7%, they kind of froze, and that's what we saw in the rates activity as well, is that it's not my market to buy. And then come this spring of 2023, you were seeing much more activity around home buying, at least the buyer's interest, is because I guess they have come to a point where like this is the new normal, and they kind of have to adjust to it. If that means I have to buy a smaller property, I can qualify for a smaller loan amount, that's fine, but buyers' needs are sometimes more urgent than sellers' needs, because I have to move to their school or whatever the reason might be, or have a kid on the way and I need to buy a home. Sellers' needs are usually not, typically not that urgent, and that's why I think Joel mentions that unless the benefit is not significant, you're not seeing a lot of in-county movement saying, yeah, I just want a bigger house, but I want to live in the same area that where I lived. But if I have to move from California to Florida, I'll make that move because that's for a bigger benefit that I have. Also, I think that at some point in time we will see that initial shock going away for sellers as well. I know that their needs are not that urgent, so we might not see that until 2024. But at some point in time, they'll be in the same boat as the buyers are right now, which is at some point we have to sell this thing because of whatever, because of the equity that we have in this house or whatever the reason might be. So they can sit for another year or so, but you will probably see a little bit more listing activity as this thing normalizes, and hopefully the rates will go down a little bit later this year and next year. we should see a little bit more severity. That's
Can I add one more thing too? I think we sort of talked about this earlier as well, and again, not to recap everything, but the new home sales market is all the more important because of that, right? Because you have this locked-in inventory that is typically the majority of what's for sale, but now, as was shown earlier, it was about what, a 70-30 split existing versus new, whereas it used to be 90-10. So much more activity on the new home sales side, and these are the newly built ones. And you know, getting to your point on rates, builders are offering concessions, so they're keeping the sales prices relatively stable because they don't want to start cutting those because that impacts the rest of their stock. So they're offering credits, they're offering buy downs. It's not a big share. I mean, we've seen the Black Knight data show 4 to 5%, I think, are temporary buy downs. And these give the borrowers an opportunity. I mean, depending on how that's structured, usually it's about 2 years of a lower rate before it gets to sort of the full market rate. But most people believe that that's a reasonable timeline where they can refinance after that if they need to. But I think the buy down side of things has been a topic of discussion in the home sales market. Again, because it's a combination of getting a slightly lower rate, but then also saying, yes, I'm giving up a 3% rate, but I'm going to get something better for, you know, to compensate or to offset that cost.
All right, and Joel, let me ask you about the numbers I just put up on the screen behind you. So this is the mortgage credit availability index, this is an MBA index. And so we saw credit availability steadily climb after the Great Recession. It plunged at the beginning of the pandemic, which is sort of what you would expect. But then it hasn't come back, and now it's gone down even farther. And so it's at a 10-year low now. So what's going on there? Why are lenders pulling back on the availability of mortgage credit?
Right, so there are a few different things going on. One is we did see that drop in the credit index during 2020 and 21 even though volumes were high. Before I get into that, just want to give you a quick sort of definition note. One is, or at least the index is put together based on what broker and wholesale investors are looking to purchase. What kinds of loans are they willing to purchase? And how many? What types, I'm sorry. So it's the risk levels and the different types of loans they're willing to purchase. So if they're willing to purchase, let's just say, 5 different kinds of 30-year fixed loans versus 3, that moves the index higher because again, there's a higher appetite for that. If they tighten credit criteria, so that let's just say they increase the credit score that they require, that's going to push the index down because that reduces the availability aspect or component. So that came down primarily because of risk aversion initially, and then partly also because a lot of depositories had sort of competing, I guess, uses for that deposits that they had. So PPP loans were one big one that pushed that down. Now we're at a point where you have tightening because of a few different things. One is similar kind of risk aversion, because we're all talking about a recession either now or coming, or at least a weakening in the economy, so that's part of it. The other part of it is just I would say the normalization or the right sizing of industry capacity. And so what I mean by that is, we talked about 2020 and 21 being record years for the industry. We grew because we needed to throw lots of resources and people at dealing with the high levels of volume. But then, as Shashank pointed out, we pivoted really quickly, going from a 3% rate to a 7% rate in 22. So a lot of companies found themselves with a much bigger operation than they could handle, given that they were used to 2 record years. And so that shrinkage in capacity, like I said, has actually caused a reduction in credit supply. It just gives borrowers fewer options in that sense. And that's actually dominating this index right now. And lastly, that credit quality component that we do capture in here, in a low volume environment, typically lenders do expand the credit box a little to try to gain volume. Not back to what we saw in the mid-2000s. Underwriting still is very complete, very stringent right now, but there are certainly levers, whether it's credit score or DTI, that lenders can sort of adjust to gain a little bit more volume on the margin. That is happening for some lenders. Like I said, there's risk aversion going on, but there's also some of this. but those are being dominated, or this is being dominated by the fact that just how quickly the industry had to adjust to the declining volume, and so we're just seeing this impact of fewer options, just low volume, people pulling out of channel, lenders pulling out of channels. We've seen lots of news about lenders saying, well, we're going to stay in the retail channel and not be correspondent, or some other form of that, and that's what's causing that index to really come down. And then, sorry, I don't know if you're taking a lot of time here. Finally, jumbo. I think jumbo is one that we're watching based on the liquidity issues that we're seeing in the market, and that hasn't shown up yet in this index, and it may in the coming months.
Well, Shashank, Afifa, what are you seeing on the front lines? Is that big plunge translating to what you can offer to borrowers?
I don't think so, but I think now that Joel has explained how they calculate MCI, it kind of makes sense. But you don't see that on a day-to-day basis when it comes to lending availability for borrowers. If anything, the credit box has slightly expanded. Fannie Freddie both. FHFA, I think, has a clear mandate of expanding the credit box to accommodate more minority home buyers. And because of that, we have seen several initiatives from the agencies over the last 12 months, allowing rental history to be part of mortgage credit scoring, and several other initiatives going lower on the credit score. Fannie did that to go down to 620. So if anything, we have actually seen more credit options. Of course, probably less desirable loans, less non-agency loans. The non-QM may not be that much as it used to be pre-pandemic. Jumbos have definitely taken ahead. Everything after happened with brief banking crisis that we saw, where banks are probably considering if they should be putting all their money into the jumbo lending, or if that's something they would not want to do. But other than that, regular FHA, people talking about VA, funding fees going down, FHA, mortgage insurance premium going down. So everything that we have seen from agencies, and when I say agencies, I mean Fannie, Freddie, FHA, and VA, if anything, they're trying to increase that credit box and trying to make it easier for home buyers to, especially first-time home buyers, to buy home homes.
Yeah, so in the VA space, the VA actually does not require a minimum credit score. That's up to each lender to set the minimum requirement. At least in the veteran space, we haven't seen credit requirements tightening, and a lot of it just has to be because these programs are designed to get first-time home buyers in the door, and those happen to be typically the ones with the lower credit score. And we at Veterans United, we have a program that if we get a borrower that does not meet minimum credit score requirements, we have a no obligation free credit consulting service that will help that borrower put their credit score back up so that they can become eligible to qualify. In our space, we're always trying to make the program as accessible as possible, so we haven't seen much of that in the
All right, and Joel, you already introduced the topic of mortgage spreads, but that's what you were talking about. So that gap between the 30-year mortgage and the 10-year treasury. I mean, normally it's about 1.5% to 2%, so 150 to 200 basis points. It's been bouncing around a lot lately, and it's more than 3% now. Why is that? What's happening that spreads have gone so crazy?
Yeah, so just quickly recap. I think right now one of the dominant things really is that mortgage-backed securities market. It's the fact that the Fed is reducing the size of its balance sheet. There's an excess supply of MBS out there, and like I said, there you have the additional MBS coming online from a lot of these failed banks that are pushing on that. I think looking ahead at least, we think that has to come in at some point, just given that it's just at unsustainable levels. I think, if you want to sort of look at some of the sort of, I guess, more major pieces of news that might impact that, and inflation and the Fed would be a big one. I think once we get to a point where you have fewer upside surprises to inflation, and we know that the Fed is going to hold rates and maybe even cut the Fed funds rate, and so I think that's going to help that spread come in a little bit more. So our forecast is for that to narrow a little bit. Between now and the end of the year, we have about a 240, 250 spread in our forecast. Just again, given that we do see signs of inflation cooling, maybe that the Fed will hold. But again, I can give you a list of 10 other things that might move things either way. But I think that's going to be one of the major drivers of that spread.
Okay. And the number everyone likes to give is that spreads just went back to normal. If instead of being 3%, they were 2%, but mortgage rates would be at 6% instead of 7%.
Right, exactly, yeah. So that again, the spread right now, like you said, is 300, maybe even more, right? And historically it's 180. So just the spread coming in 50 basis points, it's going to be a big difference in the mortgage rate, and that's without the 10-year moving. So if we do get again a more predictable inflation environment, if we do see inflation cooling, we talk a lot about that. Goods, inflation on goods has already sort of come in. We're waiting for that shelter component to come in. If the job market weakens, you get a little bit less wage growth, then services, inflation on services is going to come in too. So again, you get a much sort of more moderate inflation environment. That's gonna help sort of ease that, and again, that will make both the 10-year come down, right, and the spreads to narrow. So I know what you're getting to. Our forecast is for about a 5.6 rate on average in Q4.
Am I that easy to read?
I'm sorry?
Am I that easy to read?
maybe I'm jumping in, but I think those are the kinds of things that we're looking at to bring that in. So absolutely good point. I mean, the spread itself narrowing is such a big piece of where the 30-year fixed rate is. Thank you.
And so since you mentioned the Fed, I'll ask all of you, what do you expect the Fed to do next week?
I think they'll hold off. We'll skip this one. Just backing on what Joel was saying about the spreads coming down. It's funny, I was reminded when we were talking, I was reminded of a blog post I think I wrote in 2009, maybe early 2010. And I don't remember the exact numbers, but the title of the post was something like, mortgage rate should be 4.5 now, but this is the reason why it's not. And I talked about the spreads were so much higher, and I don't have the exact numbers in my head, but the spreads were so much higher in 2009. And this is not as volatile a market, or at least the economy is not crumbling as it was in 2009. So it is a bit of a surprise, but I think just the fact letting go of so much previous and the fact that a lot of secondary investors are thinking that eventually rates will go down and there will be a huge runoff on the current servicing portfolio. All of that is driving some of that. But I completely agree is that we should, even with all of that, even with all the stubbornness that we have seen with inflation and the job numbers, there are still signs that it's still suffering. So even with the banner headline of 300,000 new jobs last week, the unemployment rate still jumped. And that's significant by the way. Even though 3.7 sounds like one of the lowest we have seen in the last 30, 40 years. I mean, 0.3%, that's almost 10% jump with 1 month. So it's not as if I should be a mortgage lender and say, I hope that the unemployment rates keep going down, which is not good for the economy, of course. But it will be good for rates. So we're not hoping something super significant, but 0.5%, 75 basis points from now until the end of the year, I think is very realistic.
The Fed could cut rates about that much?
I'm saying the mortgage rates dropping.
Oh, mortgage rates could drop down to the low 6s, but yes.
So the market consensus is for a pause, but I think the biggest concern right now is what happens after that pause. And we've seen other countries, Australia, Canada, both went through a pause and then they suddenly decided to hike their rates again. So I think that's where a lot of the concern is. We will get the CPI numbers right before the Fed makes their announcement, so that's going to have a huge impact. Whether it goes up or down, I think that's going to impact the decision. So as of right now, it seems that the consensus is a pause, but everything changes, everything has to wait and see.
Right. I'm going to agree that they'll pause. I think they've been pretty clear about communicating that credit conditions or credit tightening, both, again, we talked about mortgage, but just sort of broader credit conditions have been tightening. So they are really dependent on their senior loan officer survey, which we saw tightening, whether it's for commercial, right, residential, consumer, et cetera, all different loan categories. That was already tightening pre banking sector, banking sector challenges. I think that was equivalent, or they think that's equivalent to 1 or 2 rate hikes. I think it's sort of, they're going to keep sort of the wait and see mode unless, again, we get sort of a more, I guess, unless we get a hotter inflation number in the next few months. So for now, I think they're sort of basing it on that and other things, but that's one of the things.
And I didn't follow up on that 5.4% number that you mentioned. So that's your forecast for mortgage rates at the end of
5.6.
Or 5.6.
Fourth quarter average.
Okay, fourth quarter.
Yeah. But as we know, lots of volatility between now and then. And today, I think we put out, no, not yes, it's not today. Yesterday, I think our rate was 6.8, so we have some ways to go. Yeah.
And so we heard that Odetta on this morning's economics panel say she thinks that the Fed will pause next week, but then resume hiking rates. Is that a likely scenario?
It's not in our baseline. I alluded to the possibility that we could get more persistent inflation numbers or maybe a hotter jobs report. But I think really it just comes down to that inflation number more than anything. I think, as Shashank noted, the jobs report on the surface looks strong, but I think you dive into the numbers, the household survey is showing much weaker numbers. The diffusion index is showing that jobs are being added. Yes, 300,000 jobs is a lot across the country, but fewer industries are added. So it's a sort of a narrow band of industries that are adding jobs. And again, the household survey showing declines, I think, and the unemployment rate going to 3.7, and then today's weekly unemployment claims higher. So I think there's certainly a possibility, but we think the current was at 5. I think we're at 5.25 is the number bound. That's going to be where they hold for the rest of the year.
Okay. What's the prediction for volumes for the year and next year and rates for next year?
Loose questions about predictions for volumes and mortgage rates next year.
Keep going. I'll let these guys know.
Good, Joe.
So we have a 1.8 trillion number for 23 still. I expect to go up by about 25% next year. A lot of that is going to be driven by purchase. I mean, I think percentage-wise, you do have a pretty big pickup in, not big, I think it's just an outsized pickup in refis, but coming off a very low level. So again, if rates come down, you might see some cash out activity. Borrowers who got in at 6-ish% might look at a 5.5 rate or 5, lower than that and say, let's refinance. So I think you get a little bit of a refi bump from there. Again, plus about doing the math in my head, about a 15-16% increase in purchase originations in 2024. I think that's pretty much in line with our home sales forecast and probably what you saw in some of the earlier panels that existing and new home sales are expected to increase in 24 as well. So 1.8 going to about 2.2, 24, and rates continue to come down. Like I said, 5.6 at the end of this year. Into the low 5s next year. But again, lots of noise around that.
All right, and let me switch gears and ask about AI. So we've been talking about how AI is affecting journalism, about how it's affecting the real estate market in terms of real estate sales. How is AI going to affect the mortgage industry?
So one challenge with mortgage tech that I've been in the industry for 30, 40 years now is that all the tech that we've seen, so if you see how mortgages were produced in 2008 when I got into business, to how the mortgages are produced now, it seems as if on the surface of it that you had a huge amount of technological evolution. You don't have to take papers to your bank anymore, all that stuff. But you'll see a lot of the tech enhancements that we've seen over the last decade has been mostly on the point of sale. So now borrowers can do complete applications online, they can upload documents, they get their statuses via email, text, all of that stuff. So if you understand how the mortgages work, the point of sale is day one of the 30-day process, day one of the 45-day process. There has been very little in terms of tech enhancements from day 2 to day 30. And that's the reason why you will see the average closing time in time of mortgages, even before 2008, used to be anything between 35 to 50 days, depending on the year. And it has stayed the same. The last almost 15 years, that's no data that has come from, I think ICE does a quarterly survey of mortgage closing time. So, of course, it went up during 2021 for obvious reasons. But other than that, overall, the mortgage closing time has not come down at all. It has been fairly stubborn, and that's because there has been very few tech enhancements, tech evolution with the operations part of mortgages. I think that's where, for the first time, I see that the artificial intelligence will play a huge role in that. We have done a couple of things with InstaMortgage very recently, which already has produced significant reduction in the turn times that we're seeing. Our average closing time is almost 50% compared to the industry's average. But really, where I see a lot of artificial intelligence playing a role is one, just figuring out, getting a ton of details up front. So a lot of the delays that happen in operations right now is just a lot of back and forth between customer and the processing team. AI should easily be able to read, for example, the bank statement, figure out what the large deposit says, what are the recurring withdrawals that's happening. And you don't have to go back and forth with a question or 1 week before closing, why is that happening? You can have way more personalized service to your customers through, say, your servicer, depending on what their needs are. And so I think that's, of course, there is a big play with ChatGPT, and those are taking the major headlines. But if you look at a lot of those are kind of restricted to a ton of marketing activities that you can do, a lot of writing that you can do, a lot of emails that you can do. But really, if you look at the core of what will really change the industry from an operations perspective, and eventually bring that 35, 40, 45 days closing time to what should be probably a 2 weeks closing time, which is a lot of artificial intelligence will drive that efficiency.
And my impression is that the appraisal is what really slows things down. Like that's the one part of the process where you need a human to make time in their schedule to drive to the property and either drive by or go inside. Is that the sticking point, or is it other things as well?
So artificial intelligence, just by definition, is you teach a machine by feeding millions of data points, and it learns through a process called machine learning, and then by then it's able to make decisions like humans, which is artificial intelligence, basically. That's what it is. If you look at it, Fannie Mae and Freddie Mac, through their property inspection waiver, what they have been doing is technically machine learning. That's a lot of appraisals that they've had, millions of them. Based on that, they've figured out the algorithm based on which to do property inspection waivers. So the recent initiative of the fact that you can go and do a desktop appraisal or drive-by appraisal on, and the FHFA wants to do at least 1/4 of the overall production for purchases in the future. So it has been a sticking point for sure. But that's what I'm saying, that yes, it has been a sticking point, but there have been years where appraisal turn times have been 2 or 3 years. But overall, it's almost as if it's hardwired in the industry that yes, we should take 30, 35 days to close mortgages. And what's the rush kind of thing. So there's also the culture and the people and the legacy of the people in the industry. And that of course needs to change, because technology by itself won't do that. But I'm very encouraged by what FHFA initiative is, and Senator Thompson talked about in the conference last year, is a lot of modernization and a lot of tech they're employing with appraisal, of course, to remove the biases and other stuff as well. But just the speed of it, they think that it's not really important to do everything in person and go there and take 7 days to do that. So it will definitely impact the appraisal process, but also a lot to do with underwriting. And right now you have to read 200, 300 pages of FHA guidelines, 200-300 pages of Fannie Mae Freddie Mac guidelines. If you look at ChatGPT 4 launch, when they did that, they uploaded 1,800 pages of IRS tax code, and ChatGPT could read through the entire thing, analyze, figure out the tax one of the tax calculations was very complicated, and could actually cite which IRS tax code it actually got the answer from. So again, those are the things I'm highly encouraged by, because then it should be that hard for it to figure out a 200-page guideline. We can figure out something which was written by IRS.
So is ChatGPT going to do my taxes next year?
IRS is doing free taxes. So they came up with an initiative, I think, where they will do mortgage taxes, but actually we should be able to do that once that Irish tax code is formalized there. It's still in the beta phase.
All right, I can keep asking questions all day, but yes, Jeff, go ahead.
You mentioned that the buy down is only 4% of all purchases. Can you explain that a little bit more? And then why is it so low? I'm surprised.
Yeah, the last I saw was, I think it was January through March data. It was in the 4 to 5% range of all purchase numbers. I think part of that is because it's still limited, not limited, but I think it's mostly used by builders who are trying to sell some of their existing stock or their the existing pipeline. The rest of the market, I guess non-builder market, might not, has not been using it quite as much, because I think, again, thinking about the lock-in effect, I'm thinking about, if a seller is incentivized enough, they might do it, but I think for the most part, they're happy with their rate, they have a home equity, right, but then they also have to give up this low rate to go somewhere else, so they're not really pushing, right, that as a concession, I think, for potential buyer, sorry. I think there's just, still, because inventory is so tight, there's just still lots of competition for houses, or for existing homes that, we're not at a point where that's sort of a necessary tool to incentivize a buyer, at least. So, so I was just going to say, so that's why, it still sort of leans more heavily to the new construction side of the market. That's why that share is so low.
Could it be higher in the resale market in higher cost markets like Southern California?
Yeah, I mean, it could be, but again, it's many different combinations of, how that might come about. I just think, again, with how tight things are, it's not, we're not at a point where sellers are just feeling the urge of the need to say, hey, I really need to move this house. I'm going to have to pay for someone else's buy down to get the house sold. I think, again, we're still seeing lots of properties sold with multiple offers and above list, right? So if we were in an environment where it was much slower and they really needed to sell, then I think, to your point, we would probably see some seller-funded buy downs, or even just buy downs outright. But I think
was the rate higher in late 2022? So I heard a lot of real estate agents saying that they're able to move deals because of the buy downs.
right. It could be, it could have been higher at the end of 22, given that was sort of the peak, right? We had the 7 to 7.5% 30-year fix. So I don't know. These guys are at the front lines, so I'll let them answer.
I don't know the national percentage, but Joe knows that better. But what I've noticed is exactly the same as during the winters when the rate was significantly higher, but also the market was slightly slower than where we saw post-spring of 2023. We saw more sellers were willing to give that concession, say, to be able to buy down 2% or 1% of the rate. We've seen very little in the last couple of months. The resale market, practically, we're licensed in 28 states, and in practically every market, there is lack of inventory. There are very few homes where sellers have to give that kind of incentive. I mean, we can give a couple of thousands towards closing cost credit, but to give $10,000, $15,000 to do a buy down, that's something we've seen rarely over the last 2 to 3 months. And we have actually seen most of the contracts that have come in were multiple offers on those properties, and buyers almost still sounds as if we were just witnessing yesterday, is there are contracts with appraisal contingencies rate or loan contingencies rate. So some markets are more competitive than the others, but very few markets we are seeing where sellers are willing to give that kind of credit.
All right, let me let Aldo ask this question before Ralph pulls the plug.
So that 300 basis point spread, is that structural? It seems like the market's too dependent on the Fed, that the private market really hasn't recovered since the crash. It's 15 years. Why hasn't the market healed? Why can't it take up the slack that the Fed provided? And are we stuck with the Fed having to be the buyer to avoid that spread?
I'm trying to think. I mean, I think, part of it is, like I said, that's why we don't have it going back down to that 180, at least in the next year or two, right? So I think, to your point, there does seem to be a little bit less appetite for that. But I think maybe then the explanation is because there are sort of competing investments out there that might give them a better return, right? So that's why mortgage-backed securities might not seem to be the ideal sort of, right, the ideal choice right now. And so, at least for the next couple of years, just, see more of the same, I guess, a little
Is that what
bit.
the private market wants, that 300-point spread? I mean, to get back
Oh, I see what you're saying.
to a private market, you
Yeah.
need a bigger spread.
Hard to comment. I mean, I think, time will tell, right, whether that comes back, or like you said, maybe that really is sort of the new sort of balance point, I guess. For now, I think there still is sort of this distortion from the Fed, right, trying to run off that balance sheet that it's going to be hard to tell what sort of a new normal might look like, for lack of better words. It's just the impact is so large, considering that they were really the largest buyer for so long. And I think one point there on the volatility, but it's just in all conditions, right? So they're buying no matter what happened in the market, because I think investors are sort of more sensitive to rate movements, right? To sort of compensating pricing that you have more ebbs and flows, whereas this was a more consistent flow of purchases, and now running that off just is a much bigger challenge for sort of finding sort of the true price or the true spread, like you're asking.
All right, I think we better get off the stage. We're the 2 o'clock. Thank you.